Okay, Scott. Scott Aquanno.
Oh, wait, turn this off.
I don't know. Why don't you leave it on?
Okay, following the nature of my research, as Leo talked about, I'll focus my words more on the position of the dollar, hence taking a bit more of a nationalistic view than Chris did, and less on the current fundamentals of the U.S. economy, although it should be obviously apparent that the two issues are fundamentally intertwined. I'll begin by analyzing, if somewhat schematically, the parameters of the current subprime crisis before issuing my position on the dollar, and concluding with some brief comments on the basis of U.S. dollar stability, hinting at a bit more of a theoretical position. As I see it, there are basically two issues at the heart of the current subprime capital meltdown. The first of which concerns the international interbank market, which is basically the market in which banks lend to one another to cover short-term shortfalls. With the sudden growth of bad debt associated with the high default rates in the subprime mortgage market, and now the mortgage market more generally, banks have become essentially fearful of lending to one another. Interbank transfers, which are traditionally viewed as highly secure, have suddenly posed market risk because the measures required to assess counterparty balance sheets are not available and have never been available. And two, because banks have felt the need to hoard capital to protect against future potential default risks. And we see this in both Canada, the United States, and Europe, and in Europe. And this has made the interbank market somewhat illiquid, forcing an appreciation of interest rates, real interest rates, in Europe and North America. And only the most obvious example of this is the euro-dollar LIBOR market, in which spreads have appreciated in August and December particularly, well above the intended U.S. federal funds rate, which is extremely alarming. This aspect of the crisis threatens a deep credit crunch, as rising interbank spreads are passed on to borrowers, and bank rates become disconnected from intended central bank short-term rates. Compounding the liquidity contraction in the interbank market has been the partial collapse of what's known as the securitized credit market, which is, of course, the second and to date more severe component of the subprime crisis. This problem, rooted in the way in which consumer loans are packaged, traded, and then reissued to the market, is much more technical, involving a host of financial conduits, particularly collateralized debt obligations and special purpose entities, namely structured investment vehicles. In short, special purpose vehicles or entities are subsidiary companies designed and created to remove assets and liabilities from the parent company. And they, in turn, usually fund their operations through issuing commercial paper or other debt obligations to the market, backed by the very assets which the banks or money-centered institutions have transferred to them in the first place. And hence we begin to see how complex and opaque the debt market has become. The basic problem here has been that as subprime defaults accumulated and investor concerns about the credit quality of mortgages deepened, concerns spread regarding the value of complex financial products, causing a collapse in credit creation through conduits. In fact, asset fundamentals have virtually become meaningless as the financial trust which underwrites U.S. securitized debt, or the sentiment which underwrites U.S. securitized debt, has evaporated. Which is to say that price signals and important market segments have virtually shut down, in the U.S. particularly, but also in global markets. Hedge funds, if we recall, were the most initial casualty of this process, as spreads changed in unexpected directions and tradable assets suddenly became illiquid. But money-centered banks have been the most recent casualty, as we know. Commercial and financial banks are at the center of the subprime crisis because they hold a significant portion or significant overall amount of structured credit. but also because they own, operate, and manage many of the financial conduits which the banks have transferred their credit to as an off-balance sheet obligation. As a result, banks have been forced to buy back declining assets, retransferring liabilities, obligations, or securitized debt to their balance sheets at declining market rates, forcing magnificent write-downs. And as of yesterday, in fact, total global write-downs relating to the subprime crisis topped 110 billion, and in terms of market capitalization, that decline is $600 billion. Now, there surely exists little evidence that the decline of the dollar can be wholly linked to the subprime crisis. I think it's clear that markets have been bearish on the dollar since at least 2006. But it is possible, I suppose, that the subprime episode has exacerbated the fragmentation of the dollar standard by further eroding U.S. fundamentals. And this may be the case in the future. It's a hypothetical. But what we do know is that predictions about the imminent collapse of the dollar standard, as Leo pointed out, have become essentially stylistic since August and perhaps more so November, December. If this position were correct,